for more on the markets and the Fed, I want to bring back Jim Paulsen, the chief market strategist at Wells Capital Management. And Jim, you know, in many ways, did the Fed set themselves up? You know, I mean, unintentionally, did they set themselves up for basically QE2?
Well, I think so. I think they put in the ability to allow them to do that if they want to do it. I think they're still a ways from doing anything like that. I think they certainly wanted to get themselves in a position so that they don't have to do anything else if they feel the data gets worse, and they can proceed to the outright buying of securities again, and not only just keep their balance sheet the same, but actually expand it. You know, I don't know if we learned a lot new here, Betty. I think the markets really have a knee-jerk reaction to this because is it really surprising that the Fed said the economy slowed? We knew that several weeks ago.
Right. I mean, we knew that from the data we'd been getting, right?
Yeah. I just don't think it's a shocker. I guess what I'm thinking I'm more interested in is that underlying all this, what the Fed speak yesterday, the data points are starting to get a little bit better. The ECRI weekly leading indicators now gone up for 2 weeks in a row. That hasn't happened since the soft patch started in the spring. The ISM service sector just went over 50%. Both the employment components and the service sector ISM and the manufacturing went up last month. You know, even the jobs report, as bad as it was last week, we're going to have, because hours worked went up so much, we're going to have a 0.5–10% increase probably in personal income and industrial production this month. So I think that's the more important thing for investors to keep an eye on. It's not what the Fed is thinking. It's more about what is the Main Street data going to suggest in the months ahead. And I think it might be starting to get a little better.
Right, but you've been hearing so much about how, you know, the Fed has been trying to inject this liquidity, but you're not getting any you're not getting any banks to lend, and you know, is this move going to help and all of that stuff? So even though you're getting those good data points, you're still not getting that movement of capital in the economy yet.
Well, you know, we just finished off the first year of this recovery, Betty, and we grew at 3.2% in real GDP terms in the first 4 quarters. That's better than the previous 2 recoveries in the first year. We only grew, I believe, at 1.9% in 2001 and 2.6% in 1991.
Okay.
We've also created jobs faster than we did in those past 2 recoveries, even though they're not as good as people want.
All right.
The profit cycle's better than it was. I mean, there are some good things going on, even though some things aren't happening.